Digital Assets for Investors. Chapter 3. Bitcoin and Monetary Systems. Section 1. Bitcoin Fundamentals. Bitcoin is best understood as a digital monetary system that lives on the internet. It lets people store value and send value directly without needing a bank, card network, or government office to approve each transaction in real time. Instead of one company operating the system, many independent participants run software that follows the same shared rules. That is what people mean when they call Bitcoin decentralized. Decentralized does not mean chaotic or ruleless. It means the rules are public and enforcement is spread across the network. For investors, the important idea is that Bitcoin is both a technology and a monetary system, not just a ticker symbol that trades on an exchange. Bitcoin combines three pieces that only make full sense together. First, there is the peer-to-peer network, which moves transaction information around the world. Second, there is the blockchain, the shared ledger that records the transaction history. Third, there is BTC, the native asset being transferred and stored within that system. If you remove any one of those parts, the system does not work the same way. For example, a digital asset without a trusted ledger is hard to verify, and a ledger without a native asset has nothing monetary to settle. This is why investors should think of Bitcoin as an integrated system rather than only a coin price. Traditional payment systems usually rely on a central operator to update balances and approve transfers. Bitcoin works differently because thousands of computers, called nodes, independently check whether transactions follow the protocol rules. Those rules are visible to anyone who wants to inspect the software. A node does not need permission from a central bank or a payment company to participate in verification. Changes to Bitcoin are also not dictated by one executive team with unilateral control because adoption depends on broad agreement across users, miners, businesses, and node operators. In practice, that makes Bitcoin harder to control, but also harder to change casually. For investors, that trade-off is part of Bitcoin's monetary credibility. The blockchain is Bitcoin's public ledger, meaning the transaction record can be inspected by anyone. Transactions are grouped into blocks, and each new block links back to the one before it, creating a chronological chain of records. Because those links are cryptographic, changing old records is extremely difficult once more blocks have been added after them. That is why people often describe the ledger as append only. New history gets added, but old history is not meant to be edited like a spreadsheet. Public does not mean every transaction is tied to a real name, though. It means the record is visible, while identity is only partially revealed through addresses and activity patterns. This combination of transparency and pseudonymity is unusual compared with banking systems. Bitcoin's native asset is Bitcoin, usually written as BTC. It has no physical form, no paper certificate, and no coin you can hold in your hand in the traditional sense. Ownership exists through control of private keys and recognition by the network ledger. BTC is highly divisible, which matters because a single coin can become expensive in dollar terms while still remaining usable in tiny amounts. One Bitcoin equals 100 million smaller units called satoshis, or sats. Bitcoin is also notable because total supply is capped at 21 million BTC under the protocol rules. That fixed upper limit is one of the main reasons investors compare it to scarce monetary assets like gold. People sometimes ask why anyone should trust a monetary system with no central operator. Bitcoin answers that question with a combination of cryptography, consensus, incentives, and hard protocol rules. Cryptography helps prove ownership, so only the holder of the correct private key can authorize spending. Consensus allows the network to converge on one valid transaction history rather than many conflicting versions. Economic incentives matter because miners are rewarded for helping secure the system honestly, while invalid behavior is costly and often rejected. The rules also limit both double spending and unauthorized creation of new coins. So trust in Bitcoin is less about trusting a specific institution and more about trusting transparent rules enforced by many participants. A Bitcoin transaction does not become trusted the moment you press send. First, a wallet creates the transaction and signs it using the private key that proves the sender has spending authority. Then the transaction is broadcast to the network where nodes check basic validity, such as the signature, the available funds, and whether the transaction follows the protocol rules. After that, miners may include it in a block. Once that block is accepted by the network, the payment has one confirmation. As more blocks are added after it, confidence rises that the transaction is settled and unlikely to be reversed. In other words, settlement in Bitcoin is a process, not a single bank approval message. Consider a simple example. If Alice owns 2 BTC and sends 5 BTC to Bob when Bitcoin is trading at $60,000 per coin, the payment represents $30,000 of value at that moment. Alice's wallet signs the transaction, the network checks that she really controls those funds, and a miner eventually includes it in a block. Bob may see the transaction quickly, but he gains more confidence as confirmations accumulate. That is different from a bank transfer, where finality often depends on internal ledgers and institutional promises between intermediaries. In Bitcoin, what matters is whether the transaction becomes part of the blockchain and remains buried under additional blocks. This helps investors distinguish between broadcast, confirmation, and final settlement confidence. Bitcoin is often compared with gold because both are associated with monetary scarcity. Gold is hard to extract from the earth, and Bitcoin is hard to create outside its fixed protocol schedule. Both are durable in their own way, divisible, and capable of being verified. The major difference is that Bitcoin is native to the internet, so it can be transferred globally through software rather than by moving a physical object. It can also be divided more easily into tiny units and audited in a digital ledger. The comparison is not perfect, but it is useful because it frames Bitcoin as a monetary asset rather than a productive business. That distinction matters when investors ask how value might accrue over time. Bitcoin's value does not come from cash flows like a stock or bond. It depends more on whether people continue to view it as a credible monetary asset supported by security, scarcity, adoption, and demand. That can make it attractive to some long-term investors, but it also makes it highly volatile, especially over short periods. Several misconceptions are worth clearing up. Bitcoin is pseudonymous, not truly anonymous. It is not backed by gold or dollars, and transactions are not automatically instant or free. It is also possible to lose access permanently if private keys are lost. So a serious investor should separate the long-term thesis from the operational and market risks that come with owning it. Section 2. Digital scarcity. Scarcity matters because money-like assets tend to derive part of their usefulness from being hard to create. Gold has historically held value partly because extracting more of it is slow, expensive, and uncertain. Fiat currencies are different because central banks and governments can expand supply in response to policy goals. Ordinary digital files are different again because copying them is usually almost free. Before Bitcoin, that made digital scarcity hard to achieve without a trusted issuer controlling the database. Bitcoin's importance is that it introduced a way to make digital units scarce through open rules and decentralized enforcement. For investors, that is the foundation of the digital gold argument. Bitcoin's major breakthrough was not simply creating another digital token, it was creating digital units that could be transferred online while resisting duplication, even without a central company keeping the only master record. In most digital systems, the issuer defines the supply and can change it or duplicate units inside its own database. Bitcoin instead relies on protocol rules that specify how new coins are issued and how valid ownership transfers occur. Network participants independently verify those rules rather than trusting one administrator. That means scarcity comes from enforcement, not from marketing language or brand reputation. For investors, this is the difference between a scarce digital asset in theory and one that is credibly scarce in practice. When people say Bitcoin has a 21 million coin cap, they sometimes imagine all 21 million already exist. That is not how the system works. Bitcoin's supply expands gradually over time through block subsidies paid to miners, and the total approaches 21 million asymptotically rather than hitting it all at once. In the early years, issuance was much faster, and over time it slows through a known schedule. This means Bitcoin combines two ideas, a hard upper limit and a transparent release path. For investors, that distinction matters because today's supply conditions are shaped not only by the cap, but by how much new Bitcoin is still entering circulation each day. The halving schedule is the mechanism that steadily reduces Bitcoin's new issuance. Roughly every 210,000 blocks, the subsidy paid to miners is cut in half. It started at 50 BTC per block, then fell to 25, then 12, 5, then 6, 25, and after the 2025 HEC, The key point is that this change is triggered by block count, not by a central committee making a policy decision. Everyone can know the schedule in advance. That predictability is unusual in monetary systems and helps shape long-term expectations about scarcity. It does not guarantee higher prices, but it makes supply far more legible than in most alternatives. Absolute scarcity and predictable issuance sound similar, but they describe different things. Absolute scarcity refers to the maximum total supply, the hard ceiling that Bitcoin is designed not to exceed. Predictable issuance refers to the path new coins take before that ceiling is reached. Bitcoin has both, a cap near 21 million and a transparent schedule for how new coins continue to enter circulation today. That is why a capped asset can still have ongoing issuance in the present. For investors, separating these ideas helps avoid a common misunderstanding that fixed supply means no inflation at all right now. Bitcoin's inflation rate is low and declining, but not yet zero. Bitcoin supply rules are not enforced by miners acting alone. Full nodes across the network verify each block and check whether the claimed subsidy matches what the protocol allows at that point in time. If a miner tried to create extra Bitcoin beyond the permitted amount, nodes would reject the block as invalid. In that sense, miners propose blocks, but nodes decide whether those blocks count. This is an important part of Bitcoin's design because it distributes monetary enforcement rather than concentrating it in one institution. For investors, that helps explain why the supply cap is more than a slogan. It is embedded in a verification process that many independent participants can check. In pure technical terms, Bitcoin software can be modified, just like any software. But changing the supply rules in a meaningful way would require broad acceptance across the ecosystem, including users, businesses, exchanges, wallets, miners, and node operators. If only a small group adopted a new version with different supply rules, that would likely create a separate asset rather than changing Bitcoin itself. This is why people say Bitcoin's monetary policy is socially and economically hard to alter, even if code can always be rewritten somewhere. The constraint is not just programming, it is coordination and legitimacy. For investors, that distinction is critical, because credible scarcity depends on both code and widespread acceptance of that code. Economically, a capped supply means Bitcoin does not respond to rising demand by materially increasing issuance. In a fiat system, policymakers may decide to expand money supply for macroeconomic reasons. In Bitcoin, the protocol keeps issuance on its preset path, regardless of whether demand is weak or strong. That means when demand changes, price often does most of the adjusting. Supporters see this as protection against discretionary dilution of existing holders. But scarcity alone does not produce value if demand fades. Investors therefore need both sides of the equation in view. Supply discipline may matter, but market demand still determines price. The 2024 halving provides a concrete example of how Bitcoin's issuance changes. Before the halving, miners received 625 BTC per block in subsidy. And after the halving, they received 125 BTC, with roughly 145 BTC, with roughly 144 blocks produced per day on average. Daily new issuance fell from about 900 BTC to about 450 BTC. That change happened at a scheduled block height rather than through meeting or vote. Importantly, new supply did not disappear, it simply slowed. This is a good reminder that halvings reduce the flow of new coins, not the existing stock already in circulation. For investors, that flow change is one reason halvings are watched so closely. Several common mistakes can blur the idea of digital scarcity. First, scarcity in Bitcoin is verifiable through the protocol and ledger, not just advertised by an issuer. Second, scarcity by itself does not create demand. A limited asset can still be unwanted. Third, the 21 million cap refers to the eventual maximum, not the amount already issued today. And fourth, lost coins reduce effective circulating supply, but they do not change the formal cap built into the system. These distinctions matter because investment narratives often oversimplify scarcity into a single slogan. A better approach is to ask whether supply is credibly constrained, measurable, and meaningful to market participants. You can connect Bitcoin's issuance schedule to a rough inflation estimate with a simple calculation. Suppose the post-2020 block reward is 15625 BTC, and the network produces about 52,560 blocks per year, which is roughly one block every 10 minutes. Multiplying those gives about 82,125 new Bitcoin issued in a year. If the supply base is around 19.5 million BTC, then annual issuance inflation would be about 0.42%. This is not a precise forecast, but it shows how transparent Bitcoin's supply path is compared with many monetary systems. For investors, doing the math yourself can make the scarcity thesis much more concrete. Section 3. Mining and security. Mining is the process that helps Bitcoin turn a stream of transactions into an ordered and shared history. Miners gather valid pending transactions, package them into blocks, and compete to add those blocks to the blockchain. When a new block is accepted, the network updates its common record of who owns what. Mining also releases new Bitcoin into circulation through the block reward. So mining is doing more than creating coins. It is helping the network agree on transaction order and maintain a single ledger. For investors, that makes mining central to both Bitcoin's monetary issuance and its security model. Proof of work can sound abstract, but the core idea is straightforward. Miners repeatedly try different inputs to produce a block hash that falls below the network's current difficulty target. A hash is like a fixed-length digital fingerprint generated from block data. There is no reliable shortcut to guessing a valid one, so miners must perform repeated trial and error at massive scale. That makes block production computationally costly and ties Bitcoin's security to real-world resources, such as hardware and electricity. In simple terms, proof of work turns energy and computation into a barrier against rewriting history. That costliness is not a side effect, it is the point of the security design. Finding a candidate block is only the beginning of acceptance. Transactions first wait in the mempool, where miners can select from them, often prioritizing those with higher fees when block space is limited. After a miner finds a valid proof of work, the block is broadcast to the rest of the network. Full nodes then independently verify the transactions, the block structure, and the proof of work itself. If the block is valid, other participants build on top of it and the chain advances from there. If it is invalid, it is rejected no matter how much effort the miner spent finding it. This is another reminder that miners propose, but nodes enforce the rules. Miner revenue comes from two sources. One is the block subsidy, which is newly created Bitcoin issued according to the protocol schedule. The other is transaction fees paid by users whose transactions are included in that block. Both are collected through a special transaction called the Coinbase transaction, which assigns the reward to the miner. Over time, because the subsidy keeps shrinking through halvings, fees are expected to become a more important share of miner income. That does not mean fees replace the subsidy overnight. It means Bitcoin's security budget gradually shifts from new issuance toward payment by network users. Bitcoin's supply stops near 21 million because the block subsidy keeps shrinking on a fixed schedule. Every halving cuts the number of newly created coins per block in half, so each cycle adds less to total supply than the one before it. Over many decades, issuance becomes smaller and smaller until it fades towards zero. The cumulative supply curve therefore rises quickly at first and then flattens as it approaches the cap. Importantly, this is not just an expectation based on custom. It is enforced by the protocol rules that nodes use to validate blocks. For investors, that means the supply ceiling is linked directly to how the network checks validity. Bitcoin's security is grounded in the fact that mining requires real-world expenditure. Specialized machines, electricity, cooling, maintenance, and operations all create ongoing costs for miners. To attack the network by trying to rewrite recent history, an adversary would need enormous hash power and would have to sustain those costs at extraordinary scale. A so-called 51% attack is therefore not just technically difficult, but economically punishing. And even if attempted, it could undermine confidence and reduce the value of the attacker's own rewards or holdings. This is why many people describe Bitcoin as secured by economics as much as by code. The system makes honest participation generally more rational than hostile behavior. Bitcoin aims for an average block interval of about 10 minutes, but hash power on the network is always changing. To keep timing roughly on track, the protocol adjusts mining difficulty every 2,016 blocks, which is about every 2 weeks on average. If blocks have been coming too quickly, difficulty rises, so finding the next valid block becomes harder. If blocks have been coming too slowly, difficulty falls. This adjustment helps stabilize issuance and confirmation timing over the long run, even though individual block times remain irregular. So 10 minutes is an average target, not a promise for each block. For investors, this helps explain why issuance remains predictable even as mining competition changes. A miner's income depends on more than just the reward written into a block. Total revenue per block includes both the subsidy and the transaction fees, but expected earnings also depend on what share of total network hash rate the miner controls. A miner with a smaller share finds fewer blocks on average. Costs matter too, especially electricity prices and how efficient the hardware is. Difficulty also affects expected results, because higher difficulty means more work is required to find blocks over time. This is why rising network hash rate does not automatically mean a given miner becomes more profitable. Profitability is always a moving balance between rewards, competition, and costs. Mining is often misunderstood as if it creates value from nothing, but that is not correct. It consumes real resources, and those costs are part of what gives proof of work its security properties. Another misconception is that more hash rate automatically means more profit for every miner, when in reality competition can squeeze margins. It is also important to remember that difficulty does not adjust instantly after every change in network conditions. And block height is not the same thing as difficulty. One is a position in the chain, and the other is a measure of how hard blocks are to find. Finally, as the subsidy declines over time, transaction fees become more important to miner economics. Keeping these distinctions clear helps investors avoid simplistic views of the mining business. A block explorer can make Bitcoin mining feel much less abstract. Looking at a real block, you can observe its height, the time it was found, how many transactions it includes, and which mining pool produced it. You can also see the subsidy and the total fees, then add them together to calculate the miner's total reward. Comparing the timestamp with the previous block shows that individual intervals can vary quite a bit from the 10-minute average. One block may arrive after a few minutes, while another takes much longer. That variability is normal and does not mean the system is broken. For investors, checking recent blocks firsthand is a useful way to connect theory with actual network activity. Section 4. Store of Value Thesis. A store of value is something people use to preserve purchasing power for the future. The idea is not that the asset never fluctuates, but that it can hold meaningful value across time well enough to function as savings. Investors often apply this lens to assets such as gold, real estate, cash, and increasingly Bitcoin. The core question is whether an asset can remain useful and trusted later, not just whether it is popular today. Bitcoin enters this conversation because it combines scarcity, portability, and verifiability in a digital form. From here, the more useful exercise is to evaluate it by the same monetary traits used for older stores of value. Assets that store value well tend to share a small set of practical qualities. Scarcity matters because something easy to create is easier to dilute. Durability matters because a savings asset has to last through time rather than disappear or degrade. Portability matters because value is more useful when it can be moved or transferred without excessive friction. Verifiability matters because owners and buyers need a reliable way to check authenticity. Investors use these traits as a comparison framework, not as a guarantee of future returns. Bitcoin's case as a store of value rests largely on how well it performs on these dimensions relative to alternatives. Bitcoin's strongest store of value argument begins with supply. The protocol caps total issuance at 21 million BTC and releases new coins only through mining rewards that follow a visible schedule. Those rewards are cut roughly in half every 4 years, so the rate of new issuance declines over time. Unlike fiat systems, this supply path is not designed to respond to policy goals such as growth, unemployment, or crisis management. Supporters argue that this makes Bitcoin unusually resistant to discretionary dilution. Still, scarcity alone is not enough to guarantee price appreciation. It simply provides one of the core monetary properties that some investors want in a long-term savings asset. Halvings shape long-term expectations because they reduce the flow of new Bitcoin entering the market. Every roughly 210 12RU00 blocks, the subsidy is cut in half, lowering Bitcoin's issuance rate and gradually reducing monetary inflation. Investors often pay close attention because lower new supply can strengthen the scarcity narrative over time. If demand stays steady or rises, less new supply can support price. But the market outcome always depends on demand as well, including adoption, liquidity, sentiment, and macro conditions. So the halving is best seen as a supply-side shift, not a guaranteed catalyst. It matters, but it does not act alone. Gold is durable because it is physically hard to destroy. But Bitcoin's durability is different. Its durability depends on whether the network and ledger continue to operate securely over time. Thousands of nodes maintain copies of the blockchain, and no single organization controls the full record. Proof of work helps protect transaction history by making it extremely costly to rewrite. The distributed design also reduces single points of failure, because one company shutting down does not erase the ledger. In that sense, Bitcoin's durability is the persistence of an ownership record rather than the survival of a physical object. For investors, that means network resilience is part of the asset's monetary quality. Bitcoin's digital nature gives it two strengths that are especially relevant to a store of value debate: portability and verifiability. Value can be sent globally through the network without physically moving bars, cash, or documents. Large and small transfers use the same basic rails, which is unusual compared with many traditional assets. At the same time, anyone can inspect the public blockchain and audit transaction history and supply with software. That does not remove all frictions, but it does make independent verification more direct than with many legacy systems. For an investor comparing gold, property, bank deposits, and Bitcoin, these digital strengths are a real part of the appeal. They help explain why Bitcoin is often described as internet-native money. Bitcoin shares some characteristics with both gold and fiat money, but it is not identical to either. Like gold, it is often valued for scarcity and for being difficult to increase in supply. Compared with gold, though, Bitcoin is easier to transfer across distance and easier to verify digitally. Fiat currencies still dominate everyday use and have legal and institutional support, but their supply can expand through policy. Gold and fiat also benefit from much longer histories than Bitcoin, which matters when investors think about trust. So, the comparison is not about declaring one asset universally superior. It is about understanding which monetary traits each one offers and what trade-offs come with them. The store of value thesis remains debated because Bitcoin's monetary strengths do not eliminate real risks. Price volatility can be severe, especially over months or even years, which makes short-term preservation of purchasing power uncertain. Bitcoin also has a much shorter history than gold or modern fiat systems, so its long-run role is still being tested. Regulation can affect access, custody, and adoption in major jurisdictions, and perhaps most importantly, fixed supply does not prevent demand from falling. Scarcity may support a thesis, but market demand ultimately determines whether that thesis is rewarded. That is why serious investors tend to discuss Bitcoin in probabilities rather than certainties. For a saver facing persistent inflation, Bitcoin can look attractive compared with holding cash that steadily loses purchasing power. Gold offers a long history as an inflation hedge, but it can be harder to store, move, and verify in practical everyday terms. Bitcoin offers easier digital transfer and transparent supply rules, which makes it appealing as a modern alternative for some investors. But there is a clear trade-off. A person can buy Bitcoin to escape monetary dilution and still suffer a sharp short-term market loss, such as a 20% drawdown soon after purchase. So, stronger supply rules do not remove price risk. This is why Bitcoin may fit better as a long-term thesis than as money needed for near-term expenses. A common mistake is to confuse Bitcoin's monetary design with its market behavior. Fixed supply and decentralization may support a long-term thesis, but they do not guarantee smooth price action. Volatility alone does not prove Bitcoin has no lasting value, just as scarcity alone does not prove that price will be stable. Another mistake is treating Bitcoin as a perfect substitute for gold when the two assets differ in history, risk profile, and practical use. Secure custody also matters because an asset cannot store value for you if you lose access to it. For investors, the strongest view is usually the most balanced one, a compelling thesis, but not a proven certainty. Section 5. Bitcoin Market Cycles. Bitcoin market history is often described as moving in recurring cycles, commonly framed around roughly 4-year periods. The reason is that halvings create a visible rhythm in new supply, and many observers connect that rhythm to later changes in price and sentiment. But the cycle idea should be treated as a lens, not as a clock. Supply matters, yet demand, liquidity, regulation, macro conditions, and investor psychology all influence outcomes too. So while cycle analysis can be useful for context, it does not produce certainty about exact timing. For investors, the healthiest approach is to use cycles to understand tendencies, rather than to expect a perfectly repeating pattern. The halving matters because it reduces the rate at which new Bitcoin enters circulation. About every 2 hen SR0 blocks, the block reward is cut in half, which slows supply growth immediately. If demand remains steady or grows, that lower flow of newly issued coins can tighten market conditions and support higher prices. This is why people sometimes describe halvings as creating a supply shock. But it is important to be precise. Halvings reduce new issuance, not the existing stock of Bitcoin already held by the market. And price is never driven by supply alone. Demand, sentiment, and broader financial conditions still play major roles. A typical Bitcoin market cycle is often divided into 4 phases. Accumulation comes after a major decline, when prices stabilize and patient buyers begin stepping in. The uptrend, or bull phase, follows as demand strengthens and optimism returns. Distribution appears near the top when early buyers begin selling into market strength and enthusiasm is widespread. Then comes the downtrend, or bear market, where prices fall sharply and excess speculation is unwound. These phases are not perfectly clean in real time, but they provide a useful framework for interpreting changing price action and investor behavior. They also remind us that sentiment tends to swing from pessimism to euphoria and back again. Accumulation typically begins after a painful decline has already done most of its damage. Prices stop falling as quickly, volatility may cool somewhat, and public interest usually remains low because confidence is still weak. This is often the phase when longer-term buyers quietly begin building positions rather than chasing headlines. Sentiment tends to stay pessimistic, which is part of why the phase is hard to recognize in the moment. It rarely feels exciting, and that is exactly the point. In many cycles, ownership gradually shifts from exhausted short-term sellers to more patient holders. For investors, accumulation is less about certainty and more about disciplined positioning when enthusiasm is absent. In the uptrend phase, momentum begins to feed on itself. Demand strengthens while Bitcoin supply growth remains constrained, often especially noticeable in the period after a halving. As price rises, confidence returns, more participants enter the market, and media attention expands. What begins as renewed interest can turn into broad optimism and eventually speculation. Psychology matters here, because rising prices can attract fresh buyers, which can push prices higher still. This does not mean every rally is irrational, but it does mean market behavior can accelerate beyond simple fundamentals. For investors, recognizing this feedback loop can help separate genuine adoption from late cycle excitement. Near the top of a cycle, distribution begins as earlier buyers start selling into strength. The market may still look strong from the outside, but volatility often increases and price swings become larger. Sentiment can remain euphoric even as smart money starts reducing exposure. Once buying pressure weakens, the reversal can be sharp. A bear market then resets expectations through a deep drawdown, often severe by traditional asset standards. Emotions also flip quickly, with euphoria giving way to exhaustion and then fear. For investors, this phase is a reminder that rising prices eventually invite profit-taking, and that Bitcoin's drawdowns have historically been large. MVRV is one of the better-known on-chain tools for studying Bitcoin market conditions. It compares market value with realized value, where realized value is a rough proxy for the aggregate cost basis of coins in circulation based on when they last moved. In plain language, it asks whether the market is trading far above or much closer to the average price where coins last changed hands. Historically, very high MVRV readings have often appeared near overheated tops, while low readings have often appeared near depressed bottoms. People sometimes cite top zones around 3.5 to 7 and bottom zones around 0, 7 to 1 dot, but this is a historical tendency, not a precise signal, It is best used as context alongside other evidence rather than as a standalone timing tool. Stock to flow is a model built around scarcity. It compares the existing stock of Bitcoin already in circulation with the flow of new Bitcoin being issued, and because halvings reduce that flow, the model suggests scarcity should rise over time. This makes it useful as a framework for explaining why many investors see Bitcoin as a monetary asset rather than just a speculative token. But the model has clear limits. It does not capture demand very well, and it overlooks many forces that shape real markets, such as liquidity, regulation, leverage, and investor behavior. That is why actual prices can move far above or below a smooth stock-to-flow path. Used carefully, it can sharpen thinking about scarcity, but it should not be treated as a standalone forecasting machine. The cycle around the May 2020 halving offers a practical example of how supply changes, market psychology, and on-chain metrics can interact. In March 2020, Bitcoin traded near $5,000 during a period of panic and broad market stress. Around the May 2020 halving, MVRV was near zero time, a level many analysts would describe as relatively depressed. By November 2021, price had risen near $69,000, and MVRV moved above 4, suggesting a much hotter market environment. Then, by late 2022, price had fallen near $69,000, and MVRV dropped back below 0.9. The sequence does not prove a simple formula, but it shows how halvings, valuation metrics, and investor behavior can line up across a full cycle. Cycle analysis can be helpful, but only if it is used with humility. It can provide historical context, highlight recurring patterns in behavior, and remind investors that extreme optimism and extreme fear have appeared before. What it cannot do is predict exact tops, bottoms, or timing with confidence. Price by itself is incomplete, and no single on-chain metric solves that problem. A more robust view combines price action, on-chain data, and broader macro and market context. For investors, the goal is not to find a perfect signal. It is to avoid overconfidence, keep history in perspective, and separate short-term speculation from longer-term trend analysis.